Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, the economic calendar was relatively light, with investors instead listening closely to Fed speak for any indication of officials' forecast for rates in September, particularly now in the aftermath of a somewhat cooler than expected July employment report and amid rising fears of mounting weakness ahead. According to Chicago Fed President Austin Goolsbee, for example, the Federal Reserve stands ready to intervene and, quote, fix any signs of weakness or instability in the marketplace. Expanding beyond the legal dual mandate of stable prices and full employment, Goolsbee implied that part of the Fed's job was to instill stable growth in the domestic economy. Goolsbee further indicated that policy may be too restrictive at the moment, but he did stop short of suggesting an emergency rate cut ahead of the September meeting was warranted. While Goolsbee's comments were met with some support and applause amid recent market volatility, others were more skeptical of the Chicago Fed president's comments, noting that historically the Fed's willingness or commitment to, quote, fix the economy has resulted in extreme moral hazard issues and ultimately contributed to the wild speculation in the markets. On the other hand, offering a relatively more calming message, San Francisco Fed President Mary Daly said monetary policy is simply having the intended effects of slowing activity, but it's too soon to say whether this is real weakness in the labor market or if it's simply a reflection of normalizing conditions, as Chair Powell described it. Monetary policy, Daly said, is working in the way intended. And to Daly's point, the latest read on jobless claims underscores the still positive nature of labor market conditions. Last week, initial jobless claims fell by 17,000, more than expected, dropping from 250 to 233,000, a 1 month low, and the largest decline in nearly a year. The 4 week average, however, increased slightly to 241,000, while continuing claims rose to 1.9 million, the highest since November of 21. As mentioned, however, this better than expected read on claims follows a somewhat disappointing July employment report. Recall non-farm payrolls rose by just 114,000 in July, falling well short of the 175,000 gain expected and marking the weakest increase in 3 months, with the unemployment rate rising from 4.1 to 4.3, the highest since October of 21. Of course, even taken alone, while the headline did stop short relative to expectations and the unemployment rate ticked up, nominally job creation still remains solid at an average pace of over 200,000 thus far for the year, and the jobless rate remains still well below the lower bound of what the Fed designates as the full employment range. Thus, while cooling, taken in tandem with a lower level of claims, this slower pace of hiring activity appears to be, again, more of a normalization of conditions as opposed to outright weakness. In the aftermath of the more positive claims report last week, longer term yields rallied, with the 10-year gaining 6 basis points back to 4% before ending the week slightly lower at 394. Given the high frequency of the data, however, the sizable market move simply underscores the emotionally volatile nature of markets as of late. Also last week, services activity also indicated solid conditions, with a pickup in activity at the start of the third quarter. The headline ISM moved back into expansionary territory in July after dipping below a reading of 50 for the second time in 6 months, gaining from 48.8 to a reading of 51.4, a 4 month high. In the details of the report, there were gains across most categories: prices paid, business activity, new orders, backlog of orders, and the change in inventories. Employment also gained traction, rising from 46.1 to a reading of 51.1, the first expansionary reading since January and a 10-month high. On the other hand, supplier deliveries declined over 4 points to a reading of 47.6, a 4 month low. This week, the economic calendar begins tomorrow with a look at the NFIB Small Business Optimism Index for July and a key report of the week, the PPI, followed by the CPI on Wednesday. Following hotter than expected readings in the first quarter, the CPI cooled somewhat in April, with further cooling in May and June. But with the Fed still needing further confidence in a sustainable disinflationary trend to justify a near-term adjustment in policy, all eyes will be looking towards this week's reads to see whether or not the next data point will be enough to justify a rate cut. The CPI is expected to rise 0.2 in July and 2.9% over the past 12 months, potentially declining 1/10 of a percentage point from the 3% annual gain in June. Meanwhile, the PPI is also expected to rise 0.2 in July and 2.3% year over year, potentially marking a more sizable decline from the 2.6% annual pace in June. Excluding food and energy costs, the core CPI is expected to increase 0.2 and 3.2% year over year, again, potentially offering a further 1/10 of a percentage point improvement from the annual gain in June, while the core PPI is expected to rise 0.2 and 2.7% on an annual basis, potentially falling from a 3% pace reported the month prior. As noted before, it does appear that the onus is on the data, however, to convince policymakers not to move come September, meaning any further minimal progress in price pressures is likely enough to offer the needed justification to cut rates now in just about 5.5 weeks' time. In other words, coupled with a cooler July employment report, any minimal improvement in price pressures will likely be enough to prompt the proverbial green light to cut rates. Of course, even if the Fed did opt to open the door to rate cuts as early as the third quarter, policy adjustments will likely fall short of the market's desire to return to neutral, let alone revert back to an accommodative stance anytime soon. Meaning, even under the more favorable inflation scenario of ongoing, albeit minimal, easing in price pressures, the Fed will likely opt to move in a very slow and tempered pace, keeping rates well above neutral out beyond 2025, if not longer. Getting back to the calendar, also on Wednesday, weekly mortgage applications. On Thursday, weekly jobless claims, along with an updated look at retail sales. Consumers are still out in the marketplace spending, supporting the economy, but doing so at a noticeably slower pace than over the past couple of years, particularly as now younger and lower income consumers more heavily adjust spending, reducing the amount of nominal dollars spent and reallocating expenditures towards services and away from goods. Last month, retail sales were unchanged in June, coming in better than the 0.3% decline expected and rising 2.3% on an annual basis, albeit the smallest gain in 4 months. This month, retail sales are expected to rise 0.3 in July and 2.3% year over year, matching the annual gain in June. Also on Thursday, July import and export price indices, the August Empire Manufacturing Index, the July industrial production and capacity utilization reports, along with June business inventories and the NAHB Housing Market Index for August. On Friday, July housing starts and permits, and the preliminary read on the University of Michigan Consumer Sentiment Index for August. And finally, on the Fed speak front, we will hear from a couple of Fed officials this week: Atlanta Fed President Raphael Bostic and Chicago Fed President Austin Goolsbee, again, likely offering further insight as to the expectations for a potential change in policy in September or beyond. And with that, I'd like to thank you for starting your week with Stifel.